African scams originated from the 90s, and they're still evolving, from 419 contract scams to today's business email compromise.
Sakawa dates back to Nigeria's oil boom in the late 70s. Ghanaians came into the country to take jobs in the oil fields, and the locals taught them their favorite pastime, the pen pal scam. The way it works is, you write to someone in America or England, tell them about an investment opportunity you have, or just straight up ask them for money, and they send it to you and that's it, scam over.
And I believe from the coming in of the internet from around about 1993, that's where it really became prevalent. And, it came to the full light and to the full glare of the public, basically.
As the internet took hold in Ghana, the pen pal scam was adapted to email. Then scammers started hooking up with hackers online and incorporating things like credit card fraud into their scams, which became increasingly complex.
The playbook hasn't changed, only the actors did. Our Nigerian brothers of this generation continued with the same blueprint. In this video, we revealed top 10 African scams that tricked Americans in the 1990s. The past explains today's fraud and how they evolved over time. These intelligence reports confirm direct coordination between U.S. agencies and the EFCC targeting corruption networks established in the 1990s. Now, for the listing, our expose narrator takes you through the records, how they was operated, impact on Americans, and investigative details.
I appreciate your wonderful opening, Dr. Komla. Now to the evidence. 30 years plus of fraud that targeted Americans. If you're watching on Shorts or TikTok, hit the pin link for the full breakdown, and don't forget to like and subscribe for more evidence-led top listicle African crimes.
Disclaimer. This ranking is not just a list. It is a reminder that internet fraud and cross-border scams do not end in profit. They end in exposure, indictments, extraditions, sanctions, and asset forfeiture. Empires fall. Records remain. The top 10 on the list is black money cleaning, wash. How it was operated? In the wash scam, victims were told a trove of defaced banknotes could be restored with special chemicals after paying activation or customs fees. Contact arrived by fax, letters, or early email. Demonstrations used iodine-like dyes to fake transformation. Payments are made by Western Union, money orders, or cashier's checks, with losses locked in before any cleaning session. The promise of a windfall masked a simple advance fee loss point. Impact on Americans? Older adults, small traders, and church or community leaders were targeted. Typical losses ran $2,000 to $25,000 with outliers higher. Shame, debt, and isolation followed, especially when victims recruited friends. Investigative details? By 1996 and 1999, U.S. advisories described chemical wash claims linked to advance fee solicitations, often routed through Western Union corridors and nominee accounts. Postal and Secret Service investigators traced mule networks that staged hotel room demonstrations, moved fees through money orders, and used counterfeit cashier's check returns to confuse timelines. Affidavits and seizure orders referenced shell companies and trade fronts that fronted laboratory supplies, while Interpol notices recorded cross-border complaints tied to letter and fax sprees. Where indictments were issued, courts documented restitution and asset forfeiture in late 1990s filings. Data gaps and uncertainties. Exact U.S. case totals remain uneven due to mixed categorization under advance fee fraud. Evolution trends 1990s to 2000s. The pitch began as letters and faxes, then shifted to email by 1998 to 2000. The earliest widely recorded U.S. advisories folded it under advance fee in 1997, with Secret Service and State Department materials cited. The top 9 on the list is work-at-home reshipping, parcel mule. How it was operated? In the parcel mule fraud, ads and faxes offered at-home income for receiving and forwarding packages, often purchased with stolen cards or counterfeit checks. Recruits relabeled goods and wired supposed reimbursements, minus a small commission. Contact came via classified ads, fax, and dial-up email. Western Union transfers and money orders finalized the loss, leaving the employee liable when banks reversed fraudulent payments. Impact on Americans? Stay-at-home workers and recent immigrants were targeted. Losses clustered around $800 to $5,000 in unreimbursed postage, supplies, and clawback checks, plus civil exposure and damaged credit.
Investigative details. United States Postal Inspection Service bulletins from 1997 and 1999 warned that reshipping rings funneled stolen goods through home addresses, then out via international lanes. Inspectors documented mule networks, P.O. boxes, and MSB wires supporting rapid liquidation. Where cashier's check returns hit, victims had already wired funds, preventing wire recalls. DOJ and FBI releases near 1999 to 2000 reference indictments that connected reshipping to broader internet fraud schemes, while Europol continuity reports and Interpol notices show parallel cross-border coordination. Courts recorded convictions and restitution orders in cases where recruiters issued instructions and labels from throwaway domains. Data gaps and uncertainties. Recruiter identities were often transient and in some cases appeared only as broader fraud counts. Evolution. Trends, 1990s to 2000s. The model emerged from print classifieds and fax trees, then moved to web forums by 1999-2000 as email replaced fax onboarding. Earliest recorded U.S. enforcement mentions align with 1997 postal alerts and late 1990s DOJ press notices. The top 8 on the list is fake war relief charities, war zone appeal. How it was operated. Scammers invoked West African conflict and famine to solicit donations for fictitious charities or urgent airlifts. Appeals arrived by church fax trees, letters, and early email lists. Victims wired relief funds through Western Union or bought money orders to addresses tied to remittance corridors. The emotional trigger, not due diligence, drove the loss. Impact on Americans. Faith communities and civic groups were targeted. Losses ranged from $500 to $12,000 per drive, with emotional harm amplified by reputational damage when appeals proved false. Investigative details. Throughout 1995 and 1999, federal and state consumer protection advisories warned donors to verify registration and demanded filings before soliciting across state lines. Postal inspectors noted trade fronts that mimicked NGO names and used nominee accounts to receive wires. Secret Service and FTC guidance emphasized records checks. When indictments landed, court dockets detailed asset forfeiture of balances in MSB accounts and restitution to identified donors. Interpol and Europol continuity materials show cross-border alerts where look-alike domains and letterheads confused donors. Seizure orders sometimes followed when dank compliance flagged mismatched EINs. Wire recalls were rarely successful after pickup at cash locations. Data gaps and uncertainties. Many incidents sat under the generic charity fraud, obscuring Africa-themed appeals in national tallies. Evolution trends, 1990s up to date. The model began with mailed letters and faxed appeals, pivoting to email lists and basic websites by 1999-2000. Early U.S. case mentions appear in mid-1990s advisories, with clearer internet fraud tie-ins as IFCC launched in 2000. The mainstream 1990s schemes that touched everyday Americans next hinge on indictments, cashier's check returns, and Western Union corridors. The records explain the order.
The top 7 on the list is advance fee fraud, 419, fax lottery. This was the most common in the 1990s. A letter or fax promised lottery winnings, inheritance, or oil contract proceeds if the recipient paid processing or release fees. The story used official-sounding seals and legal terms to lower doubt. Victims wired staged fees, then more fees to unblock the last tranche. The windfall never arrived. Losses are locked in the moment money is moved to remitters or nominee accounts. Impact on Americans. Teachers, retirees, and small business owners were targeted. Typical losses ranged from $800 to $18,000, often in multiple transfers split across locations. Investigative details. Between 1995 and 1999, federal consumer bulletins and USSS notes linked fee requests to Western Union corridors, mule networks, and shell company accounts. Where DOJ indictments followed, courts recorded restitution and asset forfeiture in late 1990s filings. USPIS described cashier's check returns that arrived after victims had already wired fees, defeating wire recalls. In 2000, early Internet Fraud Complaint Center statistics began separating advance fee varieties from general mail fraud, clarifying exposure. Data gaps and uncertainties. Inheritance versus contract variants were sometimes merged in state tallies. Evolution trends, 1990s to 2000s. The lure moved from postal letters and faxes to email by 1998-2000, gaining scale with bulk lists and throwaway domains. Later years added domain lookalikes and basic websites to recycle credibility. The top 6 on the list is counterfeit cashier's check overpayment, car sale overpay. How it was operated? A buyer overpaid with a convincing cashier's check for a car, equipment, or collectibles. The victim was instructed to deposit it and immediately wire the difference back. Banks initially showed provisional credits, so sellers felt safe. When the check bounced, chargebacks erased funds while the wired refund was already gone. Impact on Americans. Private sellers and small dealers were targeted. Typical losses ranged $1,500 to $12,000, plus lost goods when the handover happened before the reversal. Investigative details. By 1996 and 1999, USPIS and bank fraud advisories flagged counterfeit instruments tied to international rings using parcel mules and MSB transfers. Secret Service case notes described seizure orders on balances that remained, but cashier's check returns often arrived days after victims sent refunds, blocking recovery. DOJ filings from 1998 to 2000 show indictments that linked counterfeiters, mule recruiters, and reshipping addresses. Europol and Interpol continuity alerts documented cross-border patterns involving throwaway domains and fax instructions. Data gaps and uncertainties. Many incidents sat under generic bank fraud statistics. Evolution, trends. Fax and classified ad onboarding shifted to email by 1998 to 2000. The scam later fused with online marketplace listings, while banks refined funds availability warnings and delayed release policies. Quick one before we continue. If you're still watching and appreciate the value, hit subscribe and like. That's how you back our fight, because we face daily attacks for exposing what others hide. Share this now. Your family and friends need to stay alert. Most have no idea this is happening.
The top 5 on the list is romance and pen pal inheritance, widow's executor. How it was operated. This has been recorded as the most evergreen type of scam and has evolved to date. In the 90s, it started as early chat rooms, bulletin boards, and pen pal clubs were used to build trust. Then a widow or executor introduced a sudden inheritance snag. Legal fees or courier charges were urgently needed. Victims wired money or bought money orders to addresses aligned with remittance corridors. Emotional leverage, not investment logic, anchored compliance. Impact on Americans. Recent widowers, divorcees, and isolated users were targeted. Losses clustered at $600 to $9,000, with additional harm from identity exposure and coerced repeat payments.
Investigative details. From 1997 to 2000, FTC Consumer Sentinel entries and state AG notices began tagging romance-linked transfers distinct from general advanced fee cases. USSS and USPIS narratives described mule networks that staged notarized letters, spoofed email replies, and look-alike NGO stationery. When indictments landed, courts recorded convictions, restitution, and asset forfeiture orders. Interpol notices referenced cross-border complaint spikes tied to church listservs and early web forums. Data gaps and uncertainties. Pre-1997 cases often lacked separate romance coding, muting visible counts. Evolution or trends, 1990s till date. Pen pal mail and phone calls gave way to dial-up email and forums by 1998-2000. Later years added profile sites and stronger identity spoofing, with domain lookalikes used for lawyer confirmations. The top 4 on the list is lottery and sweepstakes imposters, Eurodraw Advance. How it was operated. Victims were told they won an overseas lottery they never entered. To release the prize, they had to pay taxes, courier fees, or insurance. Documents included stamped letters, faxed certificates, and matching email addresses to imitate official bodies. Each fee created sunk cost pressure that masked the impossibility of the claim. Impact on Americans. Seniors and community groups were targeted. Typical losses ranged from $900 to $7,000 US, sometimes pooled in church or club settings before unraveling. Investigative details. Between 1995 and 1999, FTC and USPIS advisories warned that unsolicited win notices demanded upfront fees, frequently routed through Western Union corridors and nominee accounts. Secret Service and state task forces documented seizure orders and restitution in cases where agents tied fee bursts to specific look-alike domains and P.O. boxes. In late 1999 and 2000, DOJ filings captured indictments that consolidated fax trees, spoofed email, and courier pickups into single schemes. Data gaps and uncertainties. Cross-labeling with telemarketing fraud obscured Africa origin clusters inside national totals. Evolution or trends, 1990s to 2010 with rebrand. Mail and fax cycles migrated to email by 1999-2000. Later, domain lookalikes and scripted call centers extended the life cycle, while U.S. advisories focused on no-fee-to-claim guidance. Indictments, recovered funds, and cashier's check returns converged with spoofed email and Western Union corridors. The records decide rank, and wire recalls rarely arrive in time.
Next come the schemes built on phone trunks, premium lines, and official seals. The top 3 on the list is PBX dial-through toll fraud, call cell. This was operated when fraudsters probed business phone systems and voicemail ports for default codes, then piggybacked to place high-tariff international calls. Bills arrived weeks later with unexplained overseas charges. Some rings sold stolen minutes to callers in other countries, while U.S. firms paid for traffic they never made. The trick exploited trust in office switchboards and after-hours laxity. Small offices, churches, and clinics absorbed shocks between $2,000 and $45,000 US per cycle. Disputes triggered service suspension risks and late fees, adding pressure to pay quickly. From 1996 to 1999, technical advisories and government bulletins warned that dial-through attacks targeted PBX trunks, voicemail remote access, and DISA codes, then funneled traffic through reseller corridors. Investigators traced patterns to night and weekend spikes and documented seizure orders only when intermediaries held balances long enough to flag recalls. Case narratives referenced indictment packages and restitution restitution orders, where resellers tied to mule networks marketed access via fax trees and early web forums. Postal inspectors and state AGs mapped the flow. Compromised extension, PBX trunk access, international gateway reseller to settlement accounts, with outcome tokens including fines, injunctions, and restitution in late 1990s filings. Data gaps and uncertainties, carrier contracts varied, so liability split and recovery rates differed across states and years. Evolution or trends, 1990s to 2000s. By 1999 to 2000, advisories pushed PIN rotation, lockouts, and after-hours blocks. Later years saw SIP gateways replace analog trunks, while fraud migrated to IPPBX, soft switch abuse, and premium rate call farms. The top two on the list is paper call and modem dialers, 900 trap. This was operated when websites and disks seeded auto-dial programs that silently called premium 900 numbers or routed to international paper call lines. Users thought they were browsing, but the meter was running. Victims learned only when a swollen mill appeared and the provider cited user-initiated calls. The loss point was a background dialer masquerading as a helpful utility. Households and dorm users reported charges from $80 to $1.2 thousand US per cycle. Disputes triggered service suspension risks and late fees, adding pressure to pay quickly. Investigative details. Between 1997 and 1999, consumer protection releases and technical advisories flagged dialers that altered modem settings, spoofed error prompts, and connected to premium exchanges. Enforcement actions and consent orders produced outcome tokens such as injunctions, civil penalties, and refund programs. Flow map narratives documented lure page, dialer install, premium or overseas termination, to clearinghouse settlement, with seizure orders where authorities froze merchant accounts tied to lookalike domains. Postal and Secret Service materials referenced cashier's check returns tied to bundled software offers, while FTC case files outlined restitution pools. Data gaps and uncertainties, records often merged international rate abuse with domestic 9000 billing, muting Africa-linked slices inside national totals. Evolution trends, 1990s-2000s. As browsers hardened and 9000 number rules tightened, dialers retreated. Later forms re-emerged as mobile premium SMS and subscription traps, while carrier-side blocks became the default for high-risk destinations. The top one on the list is Contract Award Advance Fee 419 Officials Oil Ministry Letter. How it was operated? Letters and faxes posed as ministry insiders promising a share of over-invoiced oil or infrastructure contracts if the American partner fronted taxes, legal clearances, or transfer codes. Seals, letterheads, and matchmaking consultants gave the illusion of a closed-door deal. Each fee felt like the last step before a large wire. The payout never came. Impact on Americans. Executives, chambers of commerce contacts, and small exporters were targeted. Losses frequently ranged from $6,000 to $150,000 split over staged clearances, with reputational harm when companies involved staff or clients. Investigative details, flow map embedded. From 1995 through 2000, federal releases and international coordination notes described indictments that involved forged letters, upfront fee bursts, spoofed email, and Western Union corridors. Prosecutors documented outcome tokens such as convictions, restitution, and asset forfeiture, while seizure orders froze balances that had not yet been cashed out by mule networks. Flow map storylines showed solicitor fax or email, to fee request, to MSB pickup or nominee account, to rapid onward withdrawal, with courts consolidating charges into wire fraud, mail fraud, and money laundering counts. International continuity materials reference coordination with Europol and Interpol notices on cross-border complaint spikes and domain lookalikes. Data gaps and uncertainties. 1990s cases sit in paper dockets or umbrella categories, so subtype counts require careful reading of charge sheets. Evolution trends 1990s-2000s. The pitch migrated from faxed letters to email by 1999-2000. Later generations added domain lookalikes, scanned contracts, and basic sites, paving the way for more polished procurement spoofing in the 2000s. If a claim asks for fees before funds move, pause and verify the record. Like and subscribe for more evidence-led breakdowns and tell us which filings or orders we should add next.